Welcome to One with the Other Way, a podcast about your journey and finances. I'm your host, James. We have Wanda and Peggy here with us today to kind of wrap up our kind of series on life events. And in this episode, we're talking about estate planning / death planning, which kind of sounds like a gloomy topic, but I think it's kind of a necessary thing to discuss in the scheme of things we're talking about here. So, Wanda, you want to kind of open up with some of the key points we're trying to make in this podcast?
Yes, well, first of all, everybody will die. It's the taxes and the death thing. Everybody will die. And everybody has stuff. We want to talk about estate planning, which is really what happens to the stuff or the things that you have when you die. That's the first. And how do you start it and how old are you when you're doing this? And then we want to emphasize this is a need for something that needs continuing review. I want to just do two caveats there. We are not legal professionals. I'm going to say that. And as a certified financial planner and an owner of Finances for Real Life, I have overview, and CFP has overview and training in estate planning. And so we're a go-to source for questions regarding estate planning. So those three topics.
Great. The first thing I think we should start into is, talking about the basics of the wills, trusts, and medical directives. What are those, and how do you even kind of start this process with either a legal professional or just asking questions to your financial advisor? Where do you begin, if you've never even touched it yet?
Right. So to provide clarity, the difference between a trust and a will says what you want to have happen to your things after you die. You use a trust if you want to dictate from the grave how you want your things to be given away, to be monitored. So that's your primary difference. Generally, we can do it with wills as long as there's not going to be challenges to the estate. A trust is a legal document. And as I mentioned, I'm not an attorney, but a trust can, when well written, guard against things that you don't want to have happen after you pass away to your things. So that's basically the difference. Will is going to be, you can leave things to people, and trust is dictating from the grave where you want your assets.
Okay, that makes sense.
Yeah. I want to clarify too. If you have a will, that means your estate, your things go through the probate process. And the probate process is a court process with a court appointed administrator. One of the funny things, though, a lot of people are doing these things online. If your will is invalidated for some legal reason that you might not know about in your state, then that can cause problems in the probate process. But a court appointed administrator is the one who is going to read the will and determine what happens to your things. And needless to say, that comes with some expenses.
We have a stat from a legal Zoom talking about how it could be anywhere between 3 to 7% of an estate would need to go towards probate. So that's not a small amount, especially if we're talking about some sizes of estates. So I guess knowing that, how do you mitigate that?
I like to remind people that we're a republic. And anything that's not cleared in the Constitution, I think it's on that 10th Amendment, the states have the right to declare how they will do things. And so for the probate process, it can be 7% and more, depending if there's a problem. But California mandates if that estate is less than 100,000. Basically, it mandates the cost is 4% of the value of the estate, is $4,000, and then above 100,000 they give you a little discount, and then after 800,000 it's 2%. It's important to look at that cost of probate and see if you can sidestep that cost. And you can easily do that with a financial advisor, with your financial assets, with your investment accounts, which I think everybody should do. I think everybody should talk to their financial advisor and or ensure that their financial assets are listed in a way to bypass probate. And so, with that said, the trust is really a titling vehicle. It titles your assets to the trust, and then the trust then dictates how the assets are distributed. Your investment accounts are also titled, they're titled in your name. And then if there's a beneficiary on an individual account, then that beneficiary is going to get that asset without regard to probate, without regard to any legal challenges. A beneficiary, as with a legal document, has the right to the asset. Again, I'm not an attorney, but generally, all things can be challenged in court. Yet a beneficiary is pretty clear cut in that the individual account will go to that beneficiary. And then a joint account can have a transfer in death or a payable on death, a POD or a TOD, that will then bypass probate. No cost to you. You go in, you see the financial advisor, away the asset goes exactly as you would like it to go. More complicated is the home. So you have the investment assets and then you have the home. And then with the home, those are a little bit more complicated because that's a real asset. Yet by state, some states allow what they call a trust and deed, which means that when you pass, the house goes exactly to the trust. And so again, bypassing probate costs. So it's a very simple thing to add to all accounts, and talking to your financial advisor can help you clarify how to do that.
Okay, so let's kind of we talked about some of these like details that we see. Let's talk about some, practicals of like someone's coming in. When do they start planning for this? When is the best time to start planning for estate planning and putting in these measures?
As soon as you have anything that is of value, right? If you buy a house, if you have children, if you have anything that is going to survive you, right? That's when you should start thinking about it. But especially if you have a family and you have children, there's a lot of things for planning for the future of your children, and the that all goes into estate planning.
Because, when you have children, right, it implies a spouse or a partner. And even the differentiation between a community property state versus a common law state versus an elective community property state. 41 states are actually common law states. And in those states, the spouse is not necessarily entitled to the assets accumulated during marriage. And so there's that differentiation between the children and the spouse. And then previous spouses, potentially, lots of issues there.
I mean, you should start planning immediately. When you open a bank account, a lot of times they'll give you a pay on death card,
Hmm.
and that's the beginning, right? And when we open accounts for our clients, we get, transfer on deaths and we get beneficiaries. So it's basically something that you start as soon as you have anything that's going to survive you.
So let's say someone like maybe a young person coming in with a new family. What are the essentials for them to focus on in estate planning at that age, as opposed to someone who's closer in retirement?
It's the same focus, I think. I
So,
mean, you're going to maybe have different things that you do, or your will maybe will be different about where you want things to go and what you have to put there. But I think the focus is the same, right? What is going to happen to your assets when you pass? And that's the same focus when you're young and when you're old. I mean, if you have children, obviously you're going to focus on your children. How do we take care of them? Maybe the assets will be liquidated in order to help the children. But I think that the focus is the same. Wouldn't you say,
so
Wanda? It's
yeah, I would agree, except that when you have children, there's also an additional need to look at who the guardian is. So,
Mm.
as minor children cannot be custodian of investment assets, there's a custodian or that legal part of who's going to mind the money for the health, education, and welfare of the children. And then there's a guardian who's going to actually nurture and be there for the children. And some people have financial issues in their family and are not comfortable with their family members being the guardian and can actually designate a bank. Bank step in as custodian. So they're not there to tell you no, but they're there to monitor to make sure it's being used for the health, education, and welfare, not for your trip to Vegas. So that's important consideration as well. The custodian and the guardian do not have to be the same. So thinking about it and what it is that you want. We'd rather you die later rather than sooner, but as soon as possible, looking at it and thinking about where you want the assets to go.
We talked about beneficiaries. We talked about when you die, avoiding probate. But what about estate taxes, which is different than probate? I know we're not tax professionals, but how do you minimize estate taxes? Would that be through a trust?
That's a good question. People always think to themselves, "Oh, if I have a trust, I don't have to worry about estate taxes." But au contraire, you do always. But fortunately, federal law is set right now, current, changes every year. I think it's at $11 million. So your state has to exceed $11 million
To pay estate
to
taxes?
pay federal estate taxes. But then there are two types of taxes when somebody passes. There's the estate tax and there's the inheritance tax. And again, we're not tax professionals, but basically the estate tax is on the decedent's right to give property to somebody, and the inheritance taxes on the inheritor's right to receive property. And interestingly, with 50 states, there's a variety of laws, and some states have estate taxes and inheritance taxes, or estate and or inheritance taxes. Generally, the federal law is around this 11 million. But again, something to talk to. What is your state doing? And then are you mindful of that as well? To your point about having a trust for avoiding taxes, you're not going to avoid taxes if you're a state, but a trust is generally, it can be revocable or irrevocable. And if it's revocable, it means I can change it anytime. If I can change it anytime, then I have total control. If I have total control over that trust in my lifetime, then the federal government says I can tax it. If you're saying, oh, hey, I have a lot of money, is with an irrevocable trust. But then an irrevocable trust gives away your money and you have no control over it. You cannot access it. And then you don't pay taxes on it. The estate does not pay taxes on it when you pass. But just, differentiate between the two. You're not going to avoid taxes if in fact you do owe taxes on your estate.
When would be a good time to consider doing a revocable versus an irrevocable trust? Obviously, you said the access to money and being able to use it, but when would someone need to consider an irrevocable trust?
When they have a lot of money.
When they
and they don't want to pay tax on it anymore. I mean, right? It's
right. Well, there's actually, it's interesting because you're exactly right. When you have a lot of money, again, talking to your financial advisor, do I have a lot of money, and will I have a lot of money in my lifetime, given that I'm 45 and I got 45 more years to go? But then the law is going to change. And there's actually one little sliver, right? Because life insurance is not taxed, yet it's generally considered part of the value of the estate. And so there's a little known thing called an ILIT trust, right, which is irrevocable life insurance trust, that some people will put their life insurance to, because the life insurance, really, you don't have control over it anyway. It's going to somebody else. And so there's that little sliver. And I think I've done that maybe twice in 35 years. And so not a lot of popularity. I don't think you've seen one yet, have you, Peggy?
No, I haven't. But these are cases that are unusual. I mean, First of all, if you don't have $11 million, you probably don't need to do an irrevocable trust during your lifetime. Right?
Mm-hmm.
And so you're talking about over $11 million worth of net worth. And if you have that, that's fantastic. Good for you. And then if you don't want to pay tax, right? I feel like a lot of people spend a lot of time trying to avoid tax and avoid this. And, just live your life, pay a little tax. Everybody's going to pay tax one way or the other. But aside from that, doing all these complicated things these are the exceptions. They're not the rule. Most people are going to have a will. Some people are going to have a trust. And, if you have children, you want to make sure that you're taking care of your children with insurance or, you have custodians and guardians and all of that. So irrevocable, you've given the money away.
Mm-hmm.
You don't get the money anymore. You don't get to say what happens to the money anymore. It's done. You don't own that anymore. That's irrevocable. Revocable, it's still your money. You pay tax on it, but you can do what you want with it. You can change it.
So now I kind of want to go into something that I do think is more common, and it's talking about power of attorney. Now, in talking to a financial advisor, I mean, we're not legal professionals. I'm not a legal professional. How would you explain to someone what power of attorney is and where that would come into play in their planning their estate?
So power of attorney is a right that you give another individual to take action on your behalf. This is really important in the military because you would deploy and your spouse would have to have the ability or the power to step in on your behalf. Power of attorney does not necessarily apply for financial vehicles. It has to be very specific. And again, this is a legal question. And so we want to be mindful that a lawyer is best in these cases. A financial power of attorney is a little bit different and gives you a little bit more control. Yet someone can't come into my office and say, I have a power of attorney. Can I see my spouse's IRA? I can't do that.
Yeah. Depending on what the power of attorney says. If it's a financial one, you can.
Right. So in general.
You have to look at them So a power of attorney is giving somebody else the power to act on your behalf in various ways. And when you do a power of attorney, it could be for financial matters. It could be for real estate is a different category
Yeah.
too. I
Mhm.
mean, so you're basically a basic power of attorney is you're giving somebody else the power to act on your behalf. And it could be for financial matters. It could be for all matters. It just depends on what your need is.
Okay, and then we did also talk about medical directives at the beginning. I think we should kind of
Mhm.
touch on that because, when you're thinking ahead, and we had mentioned in our long-term care planning podcast about, hey, when you're not capable to speak for yourself, when you're incapacitated, what can a financial advisor do to help explain that process to have a medical directive?
A medical directive is just what you said, right? It's somebody that is going to direct your medical care when you cannot do it because you're unconscious, because something has happened to you. It could be that you're aging and you have some kind of incapacitation. It could be that you were injured in an accident. It could be that you're in a coma, whatever. But you do a medical directive and you write in your medical directive what your wishes are. And then you assign a person to act on your behalf to make those wishes happen. And you give them that power. So, I mean, that's just another vehicle that you're going to want to have if you care about what happens to you, right? When you're incapacitated in your medical state,
Mm.
I think it's super important for aging people as well. And I think that everybody should have one.
Speaking of an agent for your medical directive, this is the person who knows you well enough to know, okay, I don't want life saving measures if I'm going to be in a coma for the rest of my life, that kind of thing. Um, there's another key person that's part of estate planning that we didn't even talk about. That was the executor. I don't
Yeah,
know how we
yeah,
haven't talked about the executor.
yeah, yeah.
I have a kind of tongue-in-cheek thing that I always say. I guess the medical person is going to be the person who knows you best there that way, but executor should be. I always say is the person that you like the least because it can be such a painful process. Because no matter what, even if everything is very clear and there's a transfer on death, the questions of like what was the value of the house and did it really cost this much to sell it and is my fair share really the right amount, and that person has to field questions regarding that. And if the house is your most valuable asset, right, that poor executor's got to go through quite the turmoil depending on who the beneficiaries are. With that said, like I said, the executor is the most important person in this estate planning thing. And the executor is the person who reads the will, looks at the trust, makes sure distribution of assets are done. And at the end, if you are a beneficiary of an estate, you have the right to demand the financial documents of the executor. So not only must the executor distribute and follow the law, even though they're not attorneys, with regard to probate, trusts, and transfer of assets, you can demand to see the financial accounting that they've done throughout the estate settlement process. And, even a simple estate, the federal government gives you a couple of years to set that up to distribute the assets and pay the taxes and that kind of thing. So executor is pretty key. I don't know how we didn't do that one.
So we've talked about all these major key players. I just kind of want to go back into a little bit about like the actual like relationship with the financial advisor as you are continually reviewing this process.
I think
Hey,
that
yeah.
it's something that you're going to review with your financial advisor and we can help guide you, right? Some people don't give us all this information for various reasons, but we'll ask these questions. And, some people may not want us to necessarily see their will, and that's okay. But if you have one, we're here to just guide you. Sometimes we know other professionals that we've worked with that maybe we can say, well, you should probably look at one of these people, then maybe they can help you get a will established, or if you need one, and then a trust, a medical directive, a power of attorney, all of these things. We're just going to ask you if you have them because that's part of just getting your financial wellness all together, right? I think we'll ask those questions. We're happy to review them. We're happy to facilitate, getting together the information you need to make one. I think those are a key thing that we can help with is getting the information together for your trust or for your will. What are your assets? Where are they? How are they listed? Are they properly titled? That kind of thing. And I think that we can help with those kinds of things. And then over time, we will ask things like, have you updated your will? You've been a client for like 10 years. We know you have a will, but maybe there's some things that need to change. Maybe some of your beneficiaries have passed, if it was a brother or sister or whatever.
I want to add two things. I love our company because Peggy keeps us all organized and moving the same direction. But annually, we do a review of beneficiaries as part of one of our quarterly topics to make sure that we're looking at that. That's the first thing. And then the second thing that we have is we use a tool that allows you to put your will and your trust in a place that if something happens to you, people can find it without having to find the key, the lockbox, the where would they put it if they were them thing. That allows that information to be out there. Because that's the other thing is you can have all the legal documents, but if you can't put your hand on it, your finger on it, then it's not going to be worth the paper that it was written on or the cloud it was placed.
Mm-hmm.
Yeah.
So, yeah.
Like Wanda said, we look at our clients' beneficiaries annually. And we're not changing them annually. We're just looking to say, hey, does every account have a beneficiary? And are you aware that these are your beneficiaries? That's it. If you've been divorced and your divorce is completely settled, you may want to change your beneficiary. Those kind of things. So I think it's...
And maybe even your trusted contact.
Maybe.
Yes, but we didn't even talk about trusted contact or what that means. So trusted contact is a different thing completely.
What is a trusted contact, Peggy?
Trusted contact is somebody that we can reach out to and let them know that we either, one, cannot get a hold of you, or that we're concerned about you because we had a phone call with you and it didn't make any sense. And that's it. The trusted contact cannot act on your behalf. They are not a power of attorney. I mean, I guess you could assign them a power of attorney, but a trusted contact is really a resource for us in case we lose contact with you, right? Maybe you're one of those people that moves all the time and we only meet with you once a year and you've moved 3 times and now we don't know what's happened. Where are you? We can reach out and say, hey, we're so-and-so and, Mr. Jones listed you as a trusted contact. We're trying to get a hold of Mr. Jones. Is he okay? And can you have him contact us? That's basically what it is. Or we can't get a hold of Mr. Jones and we saw him last week and could you check on him? Kind of a thing.
Thank you for providing clarity into what that is and that it is different than a beneficiary.
Or even than a power of attorney and can't act on your behalf. I think that's a big thing because we ask people, they're like, well, I don't want you to contact so-and-so about my accounts.
We're not contacting them unless we have a concern.
And we can't tell them
where
anything.
You are. Yes, we can't tell them.
Right. We can't say, oh, yeah, Mr. Jones has $5 million over here and we can't get a hold of him. we can't do those kind of things. We can't say anything to them except for, they've listed you as a contact. We are having difficulty getting a hold of them, or we're concerned about their safety. So basically, we have discussed wills, trusts, trusted contacts, power of attorney, medical directives. All of these things are estate planning for, accidents and the inevitable that you die, right? Everybody dies. So we encourage you to look into these things, discuss them with your financial advisor, and to prepare.
Well, thank you for listening to today's podcast on estate planning. We hope this answered any questions you may be having. If you'd like to speak more, especially about estate planning with Wanda or Peggy, you can find us at financesforreallife.com. You can find us on Spotify, Apple Music, and on YouTube. And you can see us as we post every 2 weeks. So thank you for listening to today's podcast. We hope you have a good rest of your day. Securities offered through LPL Financial, member FINRA, SIPC. Investment advice offered through Finances for Real Life, a registered investment advisor and separate entity from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.